Hi, it's John here with my top 10 tax tips for business owners and entrepreneurs. My sixth tip is to use loan agreements and understand the consequences for taking loans for your business and potentially making late repayments. So, what do you need to know about taking a loan from your company? If you do take a loan from the company has to pay tax at 32.5% at its year end. The company pays this as part of its corporation tax return, and it's basically done to stop you taking the money tax-free and running off and never repaying it. That 32.5% is repayable by HMRC when you repay the loan, because the idea is that when you do repay the loan, you've probably taken the money out as a dividend that's been taxed elsewhere. Now, sometimes it could be worth actually taking a loan out rather than taking a dividend. This is relevant if you're paying tax on your dividends at 38.1%, i.e. if you're an additional rate taxpayer earning more than £150,000 per year. In this case, the loan is actually cheaper than a dividend. What do you need to know about lending money to the company? If you lend money to your business, as is often the case when you first set up your company, you can actually charge interest on that loan. The interest does need to be at a commercial or a market rate, but there can be a tax benefit. The company can claim tax relief on the interest paid, but you might receive the interest tax-free. A basic rate taxpayer can earn up to £1,000 each year tax-free in interest. A higher rate taxpayer can earn up to £500 tax-free. However, there isn't any tax-free allowance for additional rate taxpayers. Hope you found that tax tip useful. If you'd like to learn about the other 9 tax tips, please check out our YouTube channel or our website.